So let's start off from where we left. We are going through debt capital market and debt capital market instruments. So today is also another continuation of that. So today, like what I told you last week, our focus is going to be significantly on the bond valuation topic today and next week. So I think we should be able to wind up this chapter by next week. So these 2 weeks, our entire focus is going to be on bond valuation and factors that influence the bond valuation. All right. Why are we focusing solely on bond valuation and not on debenture valuations? Both the techniques are similar. So our entire attention is going to be on debenture valuations for the next 2 weeks, including this week. So therefore, I need your full attention because these are calculations. You need to understand the rationale behind the formulas. You need to know what figure comes where. We are not only going to stop with this theory. So we have on a weekly basis when we do the calculations also, it's a platform for you to practice and send me your answers. So from tomorrow onwards, we would have a bit of calculations coming into our papers. So last few weeks, we had a lot of MCQs and a lot of theory questions. So upcoming weeks, we'll have a bit more calculations involved as well. Okay. I hope you can all hear me and it's clear. Okay. In case there are any students who have not yet shared their email address to me, I'm going to again share mine with you all. My email address, drop me an email to this address and I will include you to the weekly questions. Okay, so last week we started off by looking at two government issued instruments which are in the debt capital market but are denominated in foreign currency. What were they? Sri Lanka Development Bond and International Sovereign Bond. Sri Lanka Development Bond and International Sovereign Bond had their similarities. What were the similarities? Both of them were denominated in USD. Both of them were issued by the government of Sri Lanka through central bank. Both had a coupon payment coming in on a semi-annual basis. However, there were several differences that we noted. The main and the significant difference being Sri Lanka Development Bond targets the domestic market. International Sovereign Bond targets the foreign or the international market. Okay, that's the highlight or the heart where the two instruments actually differ. Due to this, Sri Lanka Development Bond does not have an active secondary market in Sri Lanka. Its retirement happens on maturity. Okay, but international sovereign bond, when you issue an instrument to the international market, can you say no, you cannot trade until maturity? No, you have to give them with the option of a secondary market. So international sovereign bond do have a secondary market. And remember, development bonds are long-term instruments, yes, but their tenor falls within the range of 2 to 5 years. And these instruments can be issued on a fixed margin or a fixed interest rate or on a floating interest rate basis. But international sovereign bonds are with a tenor of 5 to 10 years, a bit more longer in terms of tenor than a development bond, and those are available in fixed interest rates. Okay, remember the differences. That's the important key area. Then we went through Sukup bonds. We saw Sukup bond was issued in compliance to the Sharia law. So according to the Sharia law, there was no any interest involved in the Sukuk bond. There is a profit allocation. Due to this profit allocation in Sukuk bonds, we can see both characteristics of debt and equity instrument. What are the characteristics of equity that you can see in the Sukuk market? You get the ownership of the underlying project, business or the venture. You get exposed to the cost overruns, you get exposed to the losses of the underlying project, and you are entitled to the profit share that comes from the underlying project. What is the characteristics, what is the only characteristic that a Sukuk bond has similar to the debt instrument? It has a definite maturity period. Equity does not. There is no maturity for equity, but Sukuk has one similarity in common with the debt instrument, which is the definite maturity period. Okay, these are just ways that you could recall on what we studied last week. Then the detailed comparison is given here for your debentures. Again, remember, debenture is also a long-term debt capital instrument issued by a company. These are, even though it's long-term, usually you see with a maturity of maximum 5 years in the market. These are of several types. If it is backed by a security, you call it the secured debenture. If it's not, if it's unsecured, then it will be unsecured debenture. Practically and mostly what you see in the market is unsecured debentures. Then these instruments can come in fixed rate and floating rate, but again, mostly debentures are issued on a fixed rate term. Why? For me to explain you on the practical angle, debentures are usually issued by companies when the market interest rates are low. So when the market interest rates are low, they issue a debenture. Why? Because they get to lock in that low interest rate for a longer period. Okay, so if the market interest rates are going between 5 to 6%, and if I foresee that would increase in another 6 months, I would come in with a debenture issuance. I will tell you, for the 5 years I will offer you 7% fixed. What's the benefit on my angle? Even though for a shorter period you get a superior interest, during that 5 years I know definitely interest rate will increase, and as an issuer I will end up with the benefit. Okay, so most of the time the debentures issued tend to be on a fixed rate basis. They do issue on a floating rate, but it goes on a 90 to 10% of a composition. So if they go for a 1 billion debenture issuance, 90% of the debentures could be issued on fixed rate and only a 10% on a floating rate. Okay, then on redemption basis also you could classify debentures, but non-redeemable debentures are usually subscribed by the owners themselves. The public subscribing for such a debenture is very rare, and such a debenture being issued to the market for public offering is also very rare. Okay, and based on records you can classify debentures as registered and bearer, but again most of the debentures that you see are bearer debentures. Why? These tend to be listed debentures. Okay, then again you can classify debentures based on convertibility, but a pure debenture is a non-convertible debenture, so it stays in the form of a debt instrument from the date of issuance until its maturity. So that would be the non-convertible debenture. Convertible debenture, yes, it is issued as a debt instrument. During its tenor, it remains as a debt instrument, but on maturity, the investor has the option whether to convert it into equity or to get his money back, his principal back. Then we moved on to bond terminology. We saw what principal amount was. I highlighted it to you, principal amount, when we define talk from the, or define define the term with reference to the maturity date. It's the amount paid out to the holder on maturity. In other words, it is the face value of the bond. Okay, why is the principal amount important to us? Because it is based on this value that the investor is going to get the interest, the issuer is going to pay the interest. Okay, so the principal amount has to be known by an investor. Issue date, why do we know that? Issue date is important to us because it is from that particular day that the bond gets created or activated. In other words, it is from that particular day that interest starts to get accrued for that bond. So you need to identify when that issuance date is. So ideally, issuance date is the date the bond is offered and the settlement is made. Both needs to be happen. The offering and the settlement needs to occur at the same date. In a situation where it doesn't, the day the settlement comes in is the date on issuance. Okay. Maturity date, something that you can quickly grasp on, is the day on which the particular bond is going to expire or mature. So on that day, it ceases to give you interest, it ceases to be active. So the bond becomes expired. On that day, the investor has to return the bond certificate to the issuer, and the issuer will return the principal amount to the investor. Coupon rate, this is an annual rate. Again, I'm stressing that word to you because so many students make that mistake. Coupon rate is an annual interest rate. What does it tell you? It tells you the amount of interest paid out by the issuer for a particular year in reference to the face value of the bond. There are so many keywords here. What are the keywords? It's an annual rate. It is given in reference of, it depends on the face value of the bond, and it includes interest for the entire year. Okay. So a coupon rate is calculated by, you take the total coupon payment which would come in for a year. You add that and find out what's the total interest or the total coupon payment you will get for a year in terms of the amount. Okay, so if a bond is going to give you interest monthly, you will have 12 monthly interest amounts to add. If it's yearly, just one interest figure for you to take into consideration. That now you're going to compare against what value? You will compare it against the face value of the bond. Why am I comparing it with the face value? Because coupon is paid out by the issuer. So the issuer has to see it against the face value of the bond. In comparison to the real value of the bond, how much am I giving out as interest? This is similar to the discount rate that we calculated in the money market. Remember there, our reference of discount rate was with the value of the bond, the face value of the bond. Why? It is from that particular amount that you're giving the discount. Okay, similarly here, it is based on the face value that you're paying out the interest. So this coupon can be a fixed rate coupon and a floating rate coupon. Those we went through in detail. Current yield is a different aspect. What does that tell you? Again, current yield is an annual rate that we're talking about, annual percentage, but that will give you information, or that will indicate to you what is your return for the next 12 months or for the next 1 year if you buy this instrument today. That's why you call it current yield. It's the annual return that you can earn from the bond if you invest today. So what are you going to compare? Again, you will compare your 12 months or your annual coupon payment. Here, your comparison is going to be with the face value? No. Remember, when we spoke about face value, I told you, talk about it with reference to your maturity date. Here we are talking about current yield. If I'm buying it today, what's going to be my return? So if you're buying it today, how much are you going to pay? That depends on the current market price of that bond. So you compare the annual coupon payment with the ongoing current market price, you get the current yield. Does the coupon payment change during the life of the bond? No, it's decided, it's communicated, so it's pretty much fixed. Okay, and the coupon rate doesn't fluctuate during the tenor, but current yield can fluctuate during the tenor of the bond. Why? Of course, market price fluctuates. Whenever market price fluctuates, current yield will also fluctuate. Coupon frequency or coupon period, even though I have amalgamated both of them into one, understand coupon frequency will decide the coupon period. Why? Coupon frequency will tell you how often are you paid interest in a year. So in a year, if I am paid interest monthly, the frequency would be 12. If I'm paid interest semi-annually, frequency would be 2. If I'm paid interest annually, the frequency would be 1. Okay, so knowing the frequency will let us know about the period. So if the interest is paid monthly, frequency is 12, coupon period becomes monthly. So in a year, you will have 12 coupon periods. Okay, if coupon is paid out semi-annually, frequency is 2. Coupon period will become again twice a year. So in a year, you will have 2 coupon periods. If coupon is paid out annually, frequency is 1 and your coupon period in a year will be 1. Okay. Why do we need to know about the coupon period and the coupon frequency? Because that is very important for us to identify our cash flow. Because it is and on that particular day that you will get a cash flow from this bond. Okay, and identifying that cash flow will help you to find the real value of the bond. Now think about this. I have a 5-year bond. Interest is paid out annually. Imagine I invested in January of 2021. The interest I will get in December, even though on a nominal term will be equal to the interest I will get next year December as well. Nominally, let's assume each year I get 1000 rupees as interest, it won't change. It will be same. But time value of money comes into consideration. 1000 rupee I get this year is more valuable to me than the 1000 rupee I get next year. Why? Next year I don't know how the inflation would be. Okay, so with the 1000 I could buy relatively more items now than I would buy next year. Okay, so that's why the coupon period and the frequency is very important for us to know. Next we come to a very important area, the topic that we closed off last week, accrued interest. Why do you need to know about accrued interest? Because we are talking about a capital instrument. Capital instrument which bears interest. But he has the option of trading as well. So when he trades, does the investor hold on to the bond saying, okay, let the interest come, after the interest let me sell? If the market price is favorable, he would sell at any time. But such kind of a trade creates a loss to the issuer. Why? Sorry, it creates a loss to the initial investor. Why? Because if I sell, the interest accrued until that date, will it come to me? Will the issuer knows, oh no, this person sold on this particular date, so you split the interest, give the interest to this person and balance to the next. No, issuer doesn't know anything. What issuing company does is, on the coupon paying date, they will have a particular date in which they're paying the coupon. They will get the the bondholders list, and they will pay interest to them. Let's say day before the coupon payment, you sold it to someone. Okay, you sold it to me, let's assume. So on the coupon payment date, now my name will be there with the bond, but I bought the bond just yesterday. But now, because my name is there on that particular date, I will get the entire interest for that coupon period, and you will lose everything. To avoid that, or to ensure that a portion of the interest is paid out to the initial investor, we need to know the accrued interest amount on the trading date. That's why you need accrued interest knowledge. Okay, accrued interest helps to find the interest earned from the last coupon payment date until the day that you do your trade. Who pays the accrued interest and who receives the accrued interest? The new investor who buys the bond will pay the accrued interest to the initial buyer, to the original investor. Why? Because the subsequent buyer is entitled for the full interest. He will get the entire interest from the company. Original buyer won't have anything. So yeah, we are going to look at yield to maturity and covenants, the balance two terms that we need to know relating to bonds. Now, when we talk about yield, know that yield is always with reference to return or with reference to the investment that you have made on an instrument. Okay, so the word yield is spoken from the point of view of an investor. Now, here the term is very clear to you: yield to maturity. Now, current yield was telling us if you hold something for the next 12 years, for 1 year, what's going to be your yield? Here, we are going to talk about what is your yield with reference to an instrument if you hold that instrument until the maturity date. If you purchase on a particular date and you hold that instrument until its natural expiry or its agreed maturity date, what's going to be your yield or return to the investor in comparison to the amount paid? Okay, so if we are going to talk about return or yield until maturity, then we will have to include all cash flows coming from a bond. Now, think about current yield that we spoke about. In current yield, we were looking at just coupon payment for the next one year or the next 12 months. That was the simple concept. But here, you are going to hold it until maturity. You will have several years included, entire coupon pattern being included, and the repayment of the principal amount as well. So the entire life of the bond will get reflected in the yield to maturity calculation. So it will take the purchase cost, your coupon payments, and the return of principal on maturity as well. Now again, yield to maturity is denoted as a percentage. Okay, so what I was explaining was yield to maturity. So yield to maturity for the issuer, what they could do to the investor, what they could do to improve the return is by investing or buying the bond at its lowest price. Why? If I have to pay 1,000 rupees to get a return of 50, and if someone else can only pay 900 and get the same return, obviously the other person has a higher yield to maturity percentage than myself. Why? The investment amount is less for them. That's why we always say yield to maturity is inversely related to the price of the bond. If the yield has to be higher, the price has to be lower. Okay. Finally, we have covenants. Now, the word covenants you would have definitely come across when we went through debt financing versus equity financing. Now, in equity financing, or if you opt for a share issuance to source your funds, you bring in new owners to the business. Okay. So, let's say I was the initial owner, I needed additional capital. I take two of you all on board as co-owners. Now the company will have three owners. Let's assume I have the majority stake. Still, both of the others who got onboarded will have their different views. There can be clashes. The business has to run based on three persons' view and decisions. Okay, their involvement or control on the business is definitely there. But if you take debt financing, I as a owner opt for a debt financing or debenture issuance to get my money. The investors who invest in the debentures don't have direct control on the company. They don't get to come for share meetings. They don't get to come for the annual general meetings. They don't take part in the business decision making processes. Okay, but their interest is also available. What is their interest? Ensure that their principal amount is paid back properly and their interest payments are being paid at the right time. So that means business has to run smoothly without any high gearing, without any collapse, things like that. So what can the investors do as a lender to the company? What can they do is they could come into an agreement with the company, with the issuer. They would say, look here, due to these risks, we would prefer to impose some covenants on you. Now, remember, covenants come in if the risk of that issuing company is very high. If the company is an excellent company, very good track record and everything, then of course, imposition of a covenant is very rare. But if the investors feel no, it's very risky to invest this company, then the investors would say, okay, we would invest in this debenture of yours, but please, there are certain conditions that we want you to comply with. Or sometimes the borrowing company itself, because they know prospective investors for these debentures could be very less, they themselves could offer to the investor, look here, you invest in this debenture, I will make sure I will run my company in these particular ways, and I won't do these particular things. Okay, so that's what a covenant is. Now this covenant can be divided into two: positive or affirmative covenants, negative or restrictive covenants. Now, what are positive or affirmative covenants? These are conditions or covenants that the company should do. Okay, and now understand where the difference is coming in. These are covenants or things or activities that the issuing company must do. For example, you must insure your assets of the company. You must issue your financial statements on time. You must use these debenture proceeds for these activities. Okay. Now here you are required, the issuing company is required to do something. They're required to perform in line with this. Sorry. They're required to perform in line with this. But negative or restrictive covenants, they are available to prohibit or to limit a certain activity. They don't ask the borrowing or the issuing company to do a certain thing. They say, no, don't do this. Don't take additional debt. Don't breach this ratio. Don't sell your assets. Don't sell the company ownership. Do not issue dividends. The way they term the covenant itself is on a don't do this. On that particular term, when you give out a covenant, it becomes a negative covenant. Now, negative covenants are a bit harmful for the company. Why? They are restricting the movement. They are drawing a circle around which the company has to operate. For example, the investor who invested in the debenture could say, no, you cannot sell the company for the next 5 years, which means even if you get a good opportunity, a good offer to buy the company, even the company performs well and someone else wants to take over the company, you cannot sell without consent of those bondholders or the debenture holders. They could say, no, as a owner you cannot get dividends for the next 5 years. You have to reinvest the profit entirely. Then again, the owner has to adhere to that if he needs to opt for that debt financing. So understand where the difference comes. Positive covenants are telling the company, issuing company, to do something. You have to act in this way, perform this, do this, is what a positive covenant. Negative covenant meaning, no, don't do this. They are restricting you from a certain activity. Now, if you take a ratio, now most of the students where they get confused is, if a covenant says you cannot breach the interest coverage ratio, then it becomes a negative covenant. If the covenant say, no, maintain the interest coverage at this particular rate, or a minimum is this amount, minimum ratio expected is this ratio, then they want you to act in such a way that the minimum is always maintained. Okay. The financial ratio is a tricky area where you can't easily identify whether the covenant is a positive or a negative. All other covenants, it's pretty much straightforward. Okay, so understand what a covenant is and whether it's a positive or a negative. And remember, negative covenants are restrictive. They can impact business decision. Now, one of the example is, if you cannot take on additional debt, the debenture holder can say, no, for the next 5 years, this is it. You cannot opt for any other debt financing. And if the issuing company agrees to that initially, then if they have any sudden long-term requirements, then they have to opt for equity financing, or they will have to bring their own investment to the company without opting for any debt financing. So that will affect the business decision. Why? Your avenues for sourcing is limited. If you don't have proper funding, you will have to drop that business idea itself. Okay. Now we are moving to bond valuation. Now, in a bond, understand the cash flows before we jump into bond valuation. Okay, what does a bond tell you? It is an agreement between the issuing company and the investor where they borrow a certain amount of money and they agree to pay coupon payments or the interest payment on specific coupon dates and to repay the principal amount on maturity. Okay. Now, issuing price can be same as face value, but it can be higher or lower than face value as well. Okay, understand that issuing price can be similar to face value, but it's not a must. That's why initially I told you when I'm defining the word principal amount, I didn't talk from the issuing date perspective. I spoke about the maturity date. Why? Because the price that you invest can be similar to your principal amount, or sometimes it can be higher, sometimes it can be lower. Again, we'll talk about that in detail when we go through. Okay. Now, after you issue a bond, you know that there is a secondary market for the bond. Okay. The bond has to get traded in that secondary market. Their price of the bond will definitely fluctuate. Okay. Why? It can be due to a market condition. It can be due to a company specific factor. But due to the market forces or due to the forces coming from company specific factors, definitely the price of the bond will fluctuate, will not get stagnated. Now, this price of the bond will become your investment. This can fluctuate, but can the coupon payments fluctuate? No. That amount is determined, agreed with when you enter into the bond investment itself. You already know the amount. Principal amount, you know the face value of the bond. So you know what is going to come at the maturity. But can you simply add all these and get your bond's value? No. So for me to know the real value of the bond, I need to identify the times in which this cash flow is coming in and the cash flow value as well. Both of these has to be known for me to value my bond. Okay. Now, bond has two particular cash inflows. One is the periodic interest payment, other is the principal repayment. Now, I am talking about cash inflows. Why am I at the moment only talking about cash inflows? Because I'm trying to value the bond. Is that instrument worth it? If I put my money in that instrument, how much am I going to get back? So for me to know that, I need to know about the inflows from that bond. So what are the inflows of that bond? You will have regular interest payments coming in, and on maturity, you will have the principal repayment. Now, using these two cash flows, I'm going to value my bond. Now, my one requirement is correct or satisfied. What is that? I know what cash flows are coming from that bond. Now, I need to know when are these cash flows coming in. Okay. For that, you will have 4 steps in calculating. Now, if you take the bond, let's say this is your investment date or the issue date per se of that bond. This is going to be the maturity date. Okay. Now this will happen, let's say 2026. Issued on 2021, January 1st. Let's say interest payment is going to happen yearly. So you will have 5 years in between. So my first coupon payment is going to come in December 2021. Next coupon payment is going to come on December 2022. Then here 2023. 2024, and here you will have 2025, the very last. So on this particular year you will have your final coupon payment and your principal as well. Now see the timing of these cash flows. Even though the amount is going to be the same, I told you coupon in amount terms will not differ. Why? Coupon rate we already know. I'm talking about a fixed rate coupon. Okay. In a fixed rate coupon, I already know my coupon percentage. I know the face value. Both of these are not going to change. So the amount is more or less fixed. Okay. Now, even though the amount is similar across all these, the timing is going to be different. Let's say the coupon payment is 1,000 rupees. The 1,000 I get this year December is more valuable to me than the 1,000 I'm going to get in 2022 or 2023. So now depending on the timing, my calculation is going to involve time value of money concept. Okay, if all of them happened in just one day, then I can simply add. But now here timing is different. Therefore, for me to know the real value of the bond, I'm going to use time value of money concept in my calculations. So what is the first step when you are coming to value the bond? First step is know your interest amount. First thing that you're going to do is in a coupon period. In one coupon period, how much of an interest are you going to get? So the formula is you will have the face value of the bond. You will multiply it by the coupon rate. If you multiply it by the coupon rate, what will you get? You will get the coupon in amount terms, but that is the annual coupon. What am I trying to find? I need to find coupon payment for one particular coupon period. Now let's say interest payment is happening monthly. Then I need to know what is the coupon amount I will get for a month. If I simply multiply face value into coupon rate, I will get coupon for a year. So the answer that you get here has to be divided by the coupon frequency. If the payment is happening monthly, then the frequency is 12. So coupon for a year has to get divided by 12 for you to know coupon for a month. Okay. So the first step is for you to know the coupon payment for a coupon period. The key word here is you need to know the interest for one particular interest period. Okay. We move on to the second step. Now we know the interest for one coupon period. But even though the amount is fixed, we know the real value is different. So in the second step, we are going to find the present value of each coupon payment. So here what is going to happen? For each particular timing, I will discount the cash flow to find its present value. Now CF1 is the coupon payment for one coupon period. Okay, so that amount will be same, constant. Remember again, that's also according to the calculation, but usually it's same. Now I'm going to discount this to find the present value. What do you do in discounting? You have your required rate of return, which is for a year, this much of return I need, your assumption, your expectation. Okay, so that rate is what you expect. So from that cash flow for the period, I will adjust that particular coupon for a period divided by the anticipated required rate of return. Now remember, if this period is monthly, I need to adjust my required rate of return also to a monthly rate of return. Okay, the period has to be similar or it should be in line. Okay, so when you divide that by the required rate of return, can you just leave it as it is? No, you have to factor in the timing. This is the first coupon period. Hence, I will multiply or make sure it's a power of 1. The second cash flow is coming in the next coupon period or the second coupon period. So power 2, meaning the second coupon period. If it's the third coupon period, it has to be 3. N meaning the very last. It will continue until the very last. Let's say for 5 years, it's monthly return. So then N will be 60. The very last coupon will come on the 60th month. Okay. So using this formula, each coupon payment is adjusted to find the present value. When you add all of this together, you will get the present value of the entire coupon payments during the life of the bond. The answer or the addition of all these individual discounting will give you the present value of the coupon payments that occur during the entire life of the bond. So one particular cash flow is sorted. We saw the amount of that particular cash flow and we saw the timing of that cash flow. And using that, we have calculated the present value. So the coupon interest payment is sorted. Is that the only cash flow? No. We have another cash flow. What is that? Face value. Now, do you need to calculate the face value amount? No. It's already given in your particular question. So, one job less. You don't have to calculate to find your face value. What is the next job that you have to do? You have to find the timing of that cash flow. When is the principal repayment happening? On the maturity date. So if we go to our earlier example, on this last date, on this particular last date, you will get your repayment. Okay. So when you discount, you have the face value divided by, now you're going to divide this by the required rate of return. Now remember, you need to consider this for the timing of the cash flow as well. What is the timing of the cash flow? When are you going to get this? In the last coupon period. Now I told you, if there is a bond which is of 5-year period, monthly interest paid, then you will have 60 coupon periods. The very last coupon will come on the 60th coupon period. So when will your face value be repaid? Again on the 60th coupon period. Why? That's the very last coupon period. So N denotes the last period in which the coupon will come in. So in my example, it's 60. But here in the formula denoted as N. A way to find N, or you can write it here, N is equal to number of years into coupon periods for a year. So 5 years, let's say, and for a year there are 12 coupon payments coming in, then N would be 60, the very last. Okay, why? Because only then the face value is repaid. Now doing this will let me know the present value of the face value that I would get in 5 years time. Okay, in 5 years time, let's say I'm going to get 1 million, but it's in future terms. What is the real value or the current value of that 1 million as of today? That would be the 1 million that's going to come in 5 years would be equal to 700,000 today. Why? Due to inflation, future value has increased. But today, that in a 5 years time, if I get 1 million, that is equal to 750,000 today. That's the meaning. Okay. Now, after you go through step 3, it's simple. Now, how do you find the bond value? You have to simply add the answer from step 2 and step 3. You will add the present value of each cash flow. Present value of the coupon payments, present value of the face value. When you add these two, you will get the bonds intrinsic or the bonds true value. Okay, let's go through a question. Let's see whether you all also can attempt on your own. Present value of a 5% annual coupon bond with a 1,000 rupee face value has a 5 years to maturity. Investor expects a rate of return of 6%. Now, what's my first step? First step is to know the coupon amount. What is the coupon in amount terms? 1,000 into 5% into 1 over coupon frequency. What is the coupon frequency? It's an annual coupon bond. So annually divided by 1, meaning 50 is the answer. So every year you will get 50 rupees as your coupon payment. Now this amount has to get discounted, or you have to find the present value of this particular cash flow. So 50 discounted for the first year, 50 discounted for the second year, 50 discounted for the third year, 50 discounted for the fourth year, 50 discounted for the fifth year. Why is it just in year terms? Because here coupon period is 1 year. So maturity is 5 years. So you will have 5 coupon periods throughout the maturity period. Okay. What is going to be the rate of return? I'm going to discount it with 6%. The question itself provides that. Then step 3. What is step 3? Do I have to calculate face value? No. Already questions gives me that. 1,000. 1,000, find the present value of that 1,000 as of today. So 1,000 divided by 1 plus 6%. But when is this 1,000 coming in the 5th year? So the timing is going to be 5. Remember the letter N, the very last. So here it's 5. When I add all this, I will get the value of the bond as 957.88. This is the real value of the bond, or the bond is actually worth only this much. Why? The cash, the real value of all the cash flows that you are going to get is only this particular amount. Okay, I hope you understood. Let me go through another calculation also with you, because it's a tricky area. If a treasury bond with a face value of 100, a semi-annual coupon rate of 8.5%, and the remaining maturity exactly 1.5 years, is trading at yield to maturity of 8%. Calculate the price of the bond. Now here I'm trying to find the value of the bond midway of the bond. Okay, it's not a newly issued bond, already issued, but it has a remaining time period. I need to know the real, actual, true value of that bond. Now, I told you in earlier questions as well, whenever you get a calculation, always get the figures out of that calculation and list it out. That will help you to find what is missing and what formula to use. Okay. So face value 100 already given. Coupon rate is 8.5. Now coupon rate is an annual coupon rate. For 1 year it's 8.5. Okay. Yield to maturity, or the required rate of return, is 8%. This bond will give you 8% if you hold it until maturity. 8% is for 1 year. Okay. On a year term, it will give on average 8%. What is the coupon frequency? Semi-annual, which means for a year, they will pay me interest twice. What is the tenor remaining? How long is it left for this to mature? 1.5 years. Now 1.5 years, coupon payment coming in every 6 months. Now tell me, how many coupon periods are there then? 1.5 into 2. So the residual tenor will involve 3 coupon periods. Okay. So all the figures are known. Now let's go through in my detailed calculation technique. First one, I need to know the coupon amount. How am I going to find the coupon amount? Face value into coupon rate. Is this correct? Face value into a coupon rate gives me 8.5 rupees. This is for a year. I will get a coupon of 8.5 rupees. But in this question, coupon payment comes every 6 months. So multiply it by 1 divided by coupon frequency. So multiplied by 1 divided by coupon frequency will give me 4.25 as coupon for each coupon period. In other words, for every 6 months, you will get 4 rupees and 25 cents as your coupon payment. So first step is done. I know for each coupon period, it's going to be 4.25. What am I going to do next? I need to calculate the present value of this coupon. Now, this is the coupon amount for a Is it for a year? No, it's for 6 months. Now I need to divide this or discount it for the required rate of return. Now required rate of return is given in annual terms. For a year it is 8%. Now my cash flow is only for 6 months. Is it okay if I discount it by an annual percentage? No. I need to adjust my annual percentage as well. So for a year, if it is 8%, for 6 months, my required return is going to be 4%. Now can you see that here? Now in the formula says 1 plus r to the power 1. So the very first period, power 1 doesn't make a difference. So here it's simply 1 plus 4%. Answer you get is 1.04. In the second period, it's going to be 1 plus 4% yes, but it is coming in the second coupon period. So it's going to be when you power it to the value of 2, you will get 1.08. For the third period, you're going to power it by 3. So 1.12. All right. Now taking this into calculation, I have to simply divide my coupon cash flow by this particular discount factor and get me the present value of the cash flows. So for the first period, 4.25 divided by that particular period's discount factor. Okay. Now can you see the present value is higher to the cash flow that you get early. The earliest cash flow will have the highest value. Why? The 4 rupees I'm going to get in the first 6 months is more valuable to me than the 4 rupees I'm going to get in end of 1.5 years. Correct? So the present value is very high for the closest cash flow. So now why am I telling you this? In case you make a mistake in your calculation, these are ways that you can identify. Always in present value calculation, the cash flow you get early will give you a higher present value. Here you can see the present value of the second period is definitely not going to be lesser than third. It has to be higher. Okay, it has to go in this particular order. From the highest it goes to the lowest. Okay, now when you add all these, my step 2 is to add all these. I will get the present value of my coupon payments as 11.78. So for the balance 3 years, the actual value of all the coupon payments I will get is only 11 rupees and 79 cents. Is that the only cash flow? No. I have principal repayment. What is my principal repayment? 100. Principal repayment of 100. When is it coming? Is it coming in the first 6 months? The second 6 months? No. At the very last. Okay. So in the third and the very last period, I will get my 100. Again, I'm going to divide it by the discount factor. Now, can you see that I can use the same discount factor I used for this calculation as well? Why? It's the same timing. So, principal repayment, even though I get 100 in 1.5 years, in today's term, today that 100 is only worth 88 rupees and 90 cents. So I have my answer for the third step as well. Step 3 is also okay. Now, how do I go for step 4? Simply add present value in step 2 and present value in step 3. I will get the actual value of this bond as 100.69. Okay, that will be the simplest way to do this calculation. If you are new to this topic, if you don't understand the calculations, at least when you practice in the very beginning, use these 4 steps as the detailed technique. Don't go to use shortcuts. When time moves on, yes, you can go ahead and do with shortcuts. Okay. Now, if you are a student who can handle these calculations on your own, one way that you could simplify your technique is get the cash flow sorted first, get the amount of the coupon, get the amount of principal, and first get the total cash flow. Total cash flow for each period. Now here, if you can tackle it on your own and if you're quick in your calculations, you can use this. Here, very first step you're going to use is get all cash flows relevant for the time period. So for the first coupon period, what's the total cash flow? Second coupon period, what's the total cash flow? Third coupon period, what's the total cash flow? Second step is going to be get the discount factor sorted. For each coupon period, you're going to calculate the discount factor. Finally, simply divide the total cash flow for each period by the discount factor for that period and you will get the present value. And by adding all this, you will end up with the total answer. In this particular technique, important thing is each period you need to identify. Okay. Each period has to be sorted. And simply, first you get the total cash flow for each period, discount factor for that period, then easily get the present value, add all these 3 and you will get the actual value of the bond. Okay. If you have the slides with you already printed, make sure to put a note here, highlight this R or highlight the R over here and say, make sure that the required rate of return is in line with the period considered for the coupon. Why am I saying that? If the coupon period is 6 months, here the coupon payment will reflect only a 6-month coupon payment. Okay. So I can't divide it by a 1-year annual return. It has to be divided by the annual rate of return for 6 months. Now again, as always, by doing all this, what are we trying to achieve? By doing this calculation, what are we going to do? Now I told you, if in a bond, there are 3 cash flows. Your price that you pay to get that bond, coupon, principal, repayment. Now, using 3 of the cash flows, I found the value of the bond. What is this value of the bond? It is the intrinsic or the true value of the bond. This is what the bond is actually worth. Okay. Now, what am I going to do and know by knowing the intrinsic value of the bond? I can now figure out whether this particular bond, which has a true value of, let's say, 100 rupees, the bond is actually worth only 100 rupees. At what price is this bond trading in the market? Is it being traded at a price lower than its true value, higher than its true value, or is it traded at the true value? That is an important investment decision for the investor. For example, take any item. If you really know the actual value of that item, will you buy it if the price of that item is higher than its actual worth? In other words, it's overpriced in the market. Will you buy it? No. Why are you trying to pay more when its actual worth is less? But let's say it's being undervalued in the market. The real value, it's very expensive, but this particular seller doesn't know the actual value and it's selling at a very low price. You would grab to the offer. So for you to identify whether the bond is an overpriced bond, underpriced bond, or the bond is being correctly priced in the market, we need to do this calculation. You need to know the true value of the bond to see whether the security is overpriced or underpriced. Now coming to this decision, whether overpriced or underpriced, we are going to compare two things. You will compare the true value of the bond, which means the value that you get from the bond valuation calculation. Okay, you will take that particular amount and you're going to compare against the market price of the bond. Now in earlier question, the real value of this bond is 958 rupees. My calculation tells me this, if I buy this bond, actually the benefit in today's term, it's worth only 958. If I have to pay 1000 to buy this 958 worth bond, what happens? Is it worth it? I'm going to spend 1000 in today's term. That's going to be my price of investment. Okay, I'm going to pay 1000 and get a bond, but then bond's actual value in today's term is only 958. That tells me that this particular bond is overvalued. Why? The present value of all the cash inflows of this bond is still lower than the market price of the bond. So is it a recommendation to buy? No, it's not a good bond for purchasing. So the action or the recommendation is no, you shouldn't buy this bond or invest your money in this particular bond. Let's say you already have this bond in your portfolio. Then what should you do? Should you hold on to this bond longer? No. You have to quickly sell. Why? Because this bond is overvalued. If you keep it any longer, price is going to decline and you will end up selling at a lower price. Now you can sell it at 1000. Market price is still at 1000. The real price is only 958. So if you let it remain for a longer time, it will decline to its real price. So overvalued bonds are recommended to sell. Now think about the other scenario. Actual value of the bond is 958, but you can buy this bond in the market for 800 rupees or 850 rupees. Will you buy it? Today I have to pay 850 rupees and get a bond which is worth 958 rupees in today's term. Obviously, I'll go and buy because I have to pay a lesser amount and I can get a high valued bond. The market is undervaluing this bond at the moment. So if you identify such a bond, what is the recommendation? If you don't have that bond in your portfolio, yes, go ahead, buy that bond. Okay. If you already have that bond in your portfolio, should you sell now? No. Why? The price is low. It's undervalued in the market. The real value is much higher. So recommendation is you hold this bond. You continue to have this bond in your portfolio. Do not sell. There'll be a time where the actual price or the market price will come closer to the par value or come close to the real value of the bond. So you can sell at that particular point, not now, because now it is undervalued. What if the price of the bond is equal to its true value of the bond? The true value is 958 rupees. The market price is also 900 and let's say 60 rupees. What is the indication that you get? Okay, there is no any anomaly in the market. This bond is correctly priced. Why? The in value that I'm going to invest is the same value that I will get. That's the same worth of the bond. So, if you have this bond, yes, you can continue to hold until maturity, or you can sell off because it's correctly priced. If you don't have this bond, yes, you can go ahead and purchase because no, you're not paying something more, you're paying the correct worth of that bond. Okay. Understand what decision you're going to take from which particular pricing technique. If it's undervalued, your technique or your decision is going to be different. If it's overvalued, your decision is going to be different. What are you going to compare here to find overpriced or underpriced? The intrinsic value of the bond. You will compare it against the market price or the current market price of the bond. Okay. Now, what we are going to look at now is we have gone through the bond valuation where we saw the actual value of the bond. Then we saw whether the bond is overvalued, undervalued by comparing it with the market price. Now we are going to see what decides or what affects this bond price in the market. What influences or in the intrinsic value of this bond, the actual worth of this bond is influenced by what factors? What can increase the intrinsic value? What can decrease the intrinsic value? Okay. Now there, even when you look at the formula, you can see three. Now in this formula, so you have formula step 2 and step 3 are the biggest components. So you have three factors determining the value of the bond. Coupon payment amount, then you have the tenor, how long is it going to be, and then can the face value be different? No, face value is pretty much the same. Then you have R factor. Can you see tenor affects face value as well, and then you have another factor affecting both, which is R, the required rate of return. So these three will influence your bond value or the intrinsic value of the bond. Why am I saying face value no and base value is pretty much same and I'm taking coupon payment amount? Because between bonds, face value, high chance of face value being the same. But coupon payments between 2 or 3 bonds will be definitely different. Okay. Now, assume you have 2 bonds. One bond is giving me a coupon rate of 5%. Another bond is giving me a coupon rate of 10%. All other factors are same. Face value is same, my required rate of return, the yield to maturity is same, the tenor is same, all other factors are same, but coupon rate is the only thing that is different between these 2 bonds. What can you say about the price of this bond or the real worth of this bond? One bond is 5% of coupon rate, one bond is 10% in coupon rate. Obviously, we know the higher coupon rate bond will have a higher value. Why? Because high coupon rate meaning high cash inflow. The inflow to the bond or inflow from that bond is going to be higher in comparison to the other. So if it's a high cash inflow, obviously the value of the bond is going to increase. Okay. Let's move on to the next, required rate of return. Now, required rate of return depends on the investor. What kind of a return that the investor anticipates from this particular bond. Now, if I want a very high required rate of return, then obviously the value of the bond has to be lower. If the investor expects a very low required rate of return, then he is okay with investing in a bond which has a higher value. Obviously, it will have a higher value to the bond then. Why? That decides the required rate of return, decides your discounting. If you are going to expect higher return, then you have to discount it by a very high rate. Then what remains is very low. The value of the bond will decrease. Time to maturity. How long or how but the balance tenor left for its maturity. Now let's say all other factors are same, but one bond has 3 years left to maturity and another bond has 5 years left to maturity. What will you prefer investing in? If all other factors are same, what would you want to invest in? Rationally, the investment which will give me the earliest cash inflow. So shorter term to maturity will be more valuable to you. Why? The cash inflow will come quickly to me. Subsequent fluctuations are very less. So longer term to maturity. If a bond has a very long time left until maturity, such a bond will have a low value or low intrinsic value. Now this has 2 reasons. One is if it has a longer term to maturity, high levels of fluctuations coming in, uncertainty, therefore they expect a higher rate of return. If you have a lot of uncertainty in the market, you expect a higher rate of return, right? Therefore also the value of the bond will decrease. That is one way to justify. Other way is if it's a longer term to maturity, What is your biggest cash inflow? Is it the coupon payment or the face value repayment? The face value repayment. Now, your face value repayment, if you get it early, value of the bond is going to be higher. But if you get it much delayed, much later, then the value of the bond will decline. Why? It's going to take a longer time to get your biggest cash inflow. So mathematically, the present value of that face value is going to further decline. Therefore, again, it will result in a lower value of the bond. Now, remember this area, factors influencing the bond's real or actual price, the true price of a bond. Here when we are talking on each individual factor. All other factors are constant. If we are talking about coupon rate, all other factors, yield, time to maturity, everything else, credit quality of the bonds are all the same. Required rate of return, then again coupon rate, time to maturity, all those are constant. Only one factor changing, and what is its influence on the bond price. So in the note, I would have given you detailed calculations. What I want you to do is, when you go through this, attempt each of these as a separate practice question for you to do your bond valuation. Okay. Now here I have given it as an example, but do it on your own and familiarize in the calculation. Okay. Now can you see, this was our earlier example. Earlier example, we had coupon payment of 50 per year. $50 per year, and then you have 1,000 coming in the last year. Then you have the discount rates. You arrive at the price of the true price of the bond as 957.8. Okay, same factors are given here. But now what are we going to do? We are going to adjust only the coupon rate. We are going to hold all other factors constant and only adjust the coupon rate. Now let's increase the coupon rate to 6%. Now can you see, coupon is similar, is increased. Okay, it's definitely higher than the earlier coupon rate. So that results in the value of the bond to increase. Value of the bond has increased from 958 to 1,000. Let's increase it further 7, even higher. So when coupon rate increases, the value, true value of the bond increases. What is the rationale behind that? Because your cash inflow is increasing. Each year, now if it's 12%, for each coupon period, the amount that you get is increasing. So when your inflow in absolute term increases, when all other factors are same, your value of the bond will definitely increase. Let's go to the second one. We'll come back to this again, but for now, let's hide it. Let's go to the second one. In the second one, again, all factors are very much similar, but let's increase the yield rate. In other words, we are increasing the required rate of return. Can you see, whenever I increase the required rate of return, what happens to the value of the bond? It is declining. It's even decreasing when yield expected is 10% for one bond, and yield expected for the other bond is only 6%. What happens? This particular bond has a very low value in compared to the other. Why is it happening like that? Here, cash inflows are same. It's static. No change in that. But let's say one investor is okay to only get 6% return. He expects each year 6%. So for him to earn a 6% return for a year, he is willing to spend, or he is willing to invest in a bond which is worth 958, because for a year he only wants 6% return. But let's say I want a required rate of return as 10%. I want a higher return rate. For me to earn a higher rate of return, then I need to ensure, if all other cash inflows are same, to invest in the lower value bond. Correct? Therefore, when all inflows are same, obviously, because I am expecting a higher return, the true value of the bond will be lesser. Okay. Finally, the tenor. You can see number of years is 5. So the value of the bond is also same. Let's increase this number of years. Can you see when I increase the number of years left for maturity, again, just like yield to yield, we can see that value of the bond is declining. Why is it happening? Because my biggest cash flow is going to get further delayed. Therefore, my value of the bond is going to decline. Now, if you actually compare when you increase the tenor and when you increase the yield rate, we know that price or the value of the bond is going to decline. That relationship we know. But the rate of decline is very fast in a yield change than in a tenor change. It will decline, but the rate at which it falls is very low. Now see, I had to increase the tenor from 5 to 13. Still, the value of the bond is above 900 rupees. Okay, but here all I had to do is increase the yield. It was at 6. I had to increase it just by 2%, and then it declined even further. But here I had to increase. The increase has to be much higher, but still the rate of decline is very slow. Why is that happening? Because even though tenor increases, for each increased tenor, I will get an additional coupon payment. Correct? Now, if it's 13 years, for 13 years, I will get coupon payment. My inflow is absolute term increasing. But why is it still declining? Because the biggest cash flow of mine is getting further delayed. Even though I get additional 50 each year, the 1000, which is the biggest cash flow, is getting delayed. So when it gets further and further delayed, the present value falls. Now can you see here? 1000 rupee coming in the end of 5th year, when all other factors are same, gave me a present value of 747. But here 1000 coming in the 13th year gets me only 468. Therefore, value of the bond declines. I hope it's clear to you. Yes, that you can. 4 decimal places, ideally 2 would be fine. But if you're going ahead with 4, that's also recommended. No problem. But minimum, always go for 2, at least 2. 4 is very safe on your end because you won't have any rounding up errors. That's a very safe way if you can do your calculations, but examiner minimum expects 2. Don't go for 1, that will cause a huge difference in your calculation. At least your discount factor has to have 2 decimal places. If you can go for 4, very great. Okay. Now, before we wind up, I want you to understand certain difference that is happening here. Now here, both this scenario, same information, no any change. We saw that if the coupon rate increases, value of the bond increases, correct? But when I was increasing, I hope you saw this. If I increase the coupon to 6, same as my yield rate or my expected return, the value of the bond is equal to the face value. Can you see that? If the coupon rate is equal to the yield rate, the value of the bond, the true value of the bond was equal to 1000. When it was lesser, value of the bond was lesser than the face value. Let's increase it further. Coupon rate is higher than the yield rate. Coupon rate is 8%. Now can you see the value of this bond is higher than the face value. Now here what am I comparing? I am comparing the coupon rate with the yield rate. Why is it happening? What is coupon rate? The interest the issuer is paying me. What is yield? That is my expected rate of return. That is, I'm talking from an investor point of view. This is the rate of return the investor expects at minimum to earn in a year. Now, in this example, yield is 6%, which means myself as an investor is expecting minimum 6% for a year as my return. But the issuer is only giving 4% as annual coupon rate. Is it enough for me? I'm expecting 6% as my return for a year. But coupon rate is only 4%. Is it enough? It's not sufficient to cover my expected rate of return. In such a situation, will there be more demand for this bond? No. If I'm expecting 6, it doesn't mean only me. No, the market would be expecting on an average of 6%. So if the issuer is only giving 4%, nobody else would be willing to buy this bond. Why? It doesn't even match our expected rate of return. So in such a scenario, to compensate for the balance, expected rate of return, issuer will have to issue the bond at a discount pricing. Can you see face value is 1000, but willing to reduce the actual value of the bond has to be lower. Why? At least from this difference 915.75, investor will get a return. Now remember, this is the true value of the bond. I told you, if the market price is equal to the true value of the bond, it is a bond which is correctly priced. Okay, so if you buy this bond at this correct price, which means you pay 915.75 today, but on maturity, you get 1000. So you have a benefit from coupon and you have an income coming in from the face value as well. By the amount you invested is lesser than the face value. Now this is the reason why when I explained the word principal amount, I didn't explain it in terms of investment point. Why? I told you issue price can get deferred in comparison to the face value. Now can you see the reason why? Here you have, for you to encourage the holders and the investors to buy this bond, you have to reduce the issue price. Why? Your coupon rate is insufficient. Let's say you are paying a coupon rate of 6%. Market is expecting 6%. Now do you have to give them any additional benefit? No. Why? Market is expecting 6%. I am giving you an annual interest of 6%. That's sufficient. So you can price, or the actual price of the bond will be equivalent to the face value. If the coupon rate is 8 or let's say 9%, market expects only 6. Now the market would be going crazy to buy your bond. Why? When they expect 6%, you're giving much more than expectation. Then issuer can always collect higher. Face value is 1000, but collect higher and attract the investors. For the investors, on average, it will come up to 6. Why? Because yes, you get a 9% coupon, but you have to pay a higher price here to get only 1000 face value bond. Okay. Now, difference between this coupon and yield will get you 3 types of bonds. Premium bonds, par bonds, and discount bonds. Now here, for you to know whether a bond is a premium bond, whether a bond is a par bond, whether a bond is a discount bond, you have to compare 2 things. What are you going to compare? Just the coupon rate with the yield to maturity, or the expected return of that bond. You're going to compare these two and see whether the interest paid is it different from what is expected by the investors. If it is not different, yes, you can go ahead, issue at the face value itself. Because why? Investor cannot demand a discount. You can't demand a premium as well. Why? You are giving the same return that is expected. But if you are giving a return in terms of coupon lesser than what investors have expected, investors want 6% return, but you are willing to only give 3% as your coupon. Investors can demand a discount. Why? because it's less attractive. They wouldn't buy this bond because the coupon is less than what they expect. Hence, that bond could be a discount bond. Let's say your coupon rate is much higher than the yield. When the market is expecting 6%, you are giving 12, double of it. Then, can the investors demand a discount? Oh no, they are highly attractive bond. Why? I want only 6%, but this bond is giving me 12. So investors are willing to pay even higher than the face value, willing to pay the premium and acquire this bond. Okay, let's stop from here for now and we'll start from here next week. A bit more to explain on this premium par and discount, but for now, understand what you need to compare. Now, why I'm telling you very clearly what I'm comparing is to take a decision whether premium par and discount is different from taking a decision whether it's overpriced or underpriced. Okay, always remember what you are comparing, and from that, what decision are you taking. Okay, so next week when we start again, let's go through premium par and discount bond a bit more detail, but you will have a bit more calculation on Sunday when you do your weekly questions on this area, just as a practice. Okay, thank you so much for listening in. Very sorry for the internet collapses that happened in between. I hope we won't have that in coming weeks. Thank you so much for listening in. I hope it was clear. Once again, I will share my email address here. If you are not someone who has shared the email with me, please do, so you all can practice the calculations. Okay, thank you so much for listening in. Have a good day.